Hi everyone, this is Melanie with Mortgage Minute. How are you doing today? We are going to talk about the automated underwriting systems today, or AUS, Automated Underwriting System. Fannie Mae and Freddie Mac came out with these automations in 1997, and they're used to help assess risk. Fannie Mae's system is called Desktop Underwriter, or DU, and Freddie Mac's system is called Loan Prospector Advisor, or LPA. And this is a great tool, and it's used today on every loan submitted, except for some manually underwritten jumbo programs. An automated underwriting system, as I said, is super cool. It looks at a defined set of criteria to evaluate the risk. It looks at your employment history, income, credit usage, and credit history, assets, property type, everything that is input. And that is the key here, everything that is input, and it makes a decision on your loan. Having an approval through an AUS system can provide document relief, which means you have to provide less to get your loan closed. For instance, if you've been on your job for a year and your employer reports income through a company called the work number, you may not have to provide any income documentation. DU and LPA can validate your income through the work number because they talk to each other. Per the work number, more than 1 million employers report income through it. And in my experience, 5 to 10% of all loans run through the AUS can have the income validated through the work number. Also, if you have an AUS approval, typically your debt ratio can be higher. And the debt ratio is the amount of your housing debt and your total debt in relation to your income. So having an AUS approval provides a lot of benefits for both you and the lender. If you have an AUS approval, sometimes you will not need to document your rental history, and sometimes you won't have to provide letters of explanation for job gaps or late payments on your credit report. However, although it can read credit history every time, and it can read your income some of the time, it is still just a tool, and it reads what is input. So let's go back to completing the application. Do you remember that video I put out? If not, please check it out. It has so much information. If you earn an hourly rate, overtime, bonus, or commission, they need to be input correctly. Otherwise, the AUS does not read your income, and it does not take into account the additional risk of the income types you have. It is the same with retirement income or Social Security. If it's put in as employment income, it is not reading your income correctly. If you're getting a gift, the AUS does need to read that, and so you do need to separate it. If you're getting a gift and the AUS is not run with the gift, it is not reading the nature of your down payment and assets. This is the reason completing the application is so important. An AUS approval with accurate information is completely different than an AUS approval with incorrect information, because that approval can change when the correct information is input. Let's talk about that. First, you do not need an AUS approval to get a loan. You will get better rates, you can have higher debt ratios, you can provide less documentation, but you do not need it to get your loan approved. Sometimes it's easy to change what is called a refer. So if you don't have an approval, you have a refer. It's easy to change that refer to an approval with just a few tweaks. Let's say your debt ratio is a little too high. Paying off a couple of small credit cards can get it in line and get that approval. Let's say you're using everything in your checking and savings accounts for the down payment and it shows you have no reserves. Maybe you have it a 401k or another retirement, and putting that in can give you the reserves that again can take it to a referral to an approval. Both of these examples are ways to change the AUS into an approval. Finally, I want to talk about the downside of an AUS and the approval. The AUS looks at a lot of things: employment history, income and assets, debt ratio, loan to value. What it doesn't look at is the guidelines. Also, an AUS does not have the capacity to see unique situations and evaluate the loan further than that specific algorithm is set up to read. And this is where our industry's gotten lazy. Loan officers, processors, underwriters, all can see an AUS approval and move it on to closing without paying attention to the underlying guidelines that still must be met. And this does cause issues for you. The loan officer is your advocate every time. Often, I as the underwriter will ask for something to meet the guideline, and your loan officer will come back and ask me to research, make sure that I actually need it, or he wants to look at the information he submitted to me to be sure that it was correct so that I am asking for what is really needed. Now, that can be good and bad for you. If I'm wrong, you weren't bothered. And if I'm right, then days could have gone by that you could have been working to obtain the information I need. And if we're getting close to a closing date, tempers get high. Fannie Mae, Freddie Mac, FHA, USDA, VA all have their own unique guidelines. So that is what I have on the AUS. Did you even know this existed? Did you know it had been being used for 25 years? In that 25 years, it's come a long way. Let me know in your comments below. Also, if there's something you would like me to address in another video, let me know that. I always read my comments and I'm happy to give you any information I have. All right, I hope this finds you well and I hope you have an awesome day. Bye.